So, seeing the economy on the verge of collapse, I did the logical thing. I sought to profit from it. Specifically, I set out to buy credit default swaps on subordinated tranches of subprime residential mortgage-backed securities. And that's where I lost my investors, too. In fact, in doing so, I gained a new level of insight into how Wall Street really works. I called different Wall Street firms, banks with which I had prior relationships due to my trading of distressed debt. I tried to convince them to trade in this market with me. Initially, I found no takers. This was March of 2005. The whole effort was complicated because it was important to me that this security, this instrument that I'd like to use to short the market, would be standardized such that if I bought a credit default swap from one dealer counterparty, I could easily trade that credit default swap to another dealer counterparty. Bespoke, one-off contracts were full of contract and counterparty risk that I would not tolerate. Nevertheless, by May of 2005, standardized contracts were on the cusp of becoming reality. In May of 2005, May 19th of 2005, we agreed to our first trades, shorting the subprime mortgage market with Deutsche Bank. We worked on these soon-to-be standardized contracts a bit, and in the first days of June 2005, the first trades that officially went through. We would ultimately use 9 different Wall Street dealer counterparties. To be clear, well, first I'd say Lehman and Bear I avoided, for obvious reasons, even back then. Goldman Sachs featured very prominently early on. They were a very anxious crew. To be clear, these credit default swaps that I'm buying would rise in value as mortgages are written off and the value of these tranches fell. Goldman Sachs in the spring of 2007 appeared to us to want to make its trade bigger. They wanted a bigger piece of the big short. A lower price, therefore, would benefit Goldman Sachs, and that's how Wall Street works. In late of June of 2007, credit spreads started marching higher, and then they just took off for once Goldman was on the same side as my trade. Then it was AIG's turn to complain about Goldman's marks. Incredibly, it would later be reported that more than $60 trillion in credit derivatives were in effect at the peak. Now, hyperbole would say that is more than the gross product of the world. But it's roughly equal, and who really knows what the gross product of the world is? How could that be? How could it even get close to the